I'm Nick Grove for Morningstar, and today I'm joined by Head of Equities Research Peter Warnes, who's here to discuss yet another batch of results from the current half-year earnings season. Peter, thanks for your time today.
Always good to be here, Nick.
First of all, Peter, NAB and ANZ delivered quarterly updates. Now, is NAB in a better position now that it's free of Clydesdale in the UK? And will ANZ be able to handle the current difficult conditions, given it's got the greatest Asian exposure among the big four?
Nick, there's no doubt that NAB is better off without Clydesdale. It's been a drag, a millstone around its neck for a number of years, and obviously post GFC when things really got hotted up over there. And so, yes, freeing up the balance sheet and more so management time to focus on, the Australian, New Zealand franchises where they have got, good market share will certainly be a benefit to the management, the bank and the shareholders. Clydesdale will do okay in its own right, but again, it's a small fish in a big pond over there, and what we say about, our big four here, you don't want to be competing against them, so the same situation in the UK, and so NAB definitely better off. That result was quite pleasing. The bad debt impairment unsustainably low, and we expect it to normalise, but that was again just shows you how benign things are in the and how good the asset quality is of the four major banks, so good result. Metrics were good, positive for shareholders. Now ANZ is a different kettle of fish. Obviously, again, the offshore operations are getting them into trouble. And they had a very, very big thrust into Asia, as everyone knows, under Mike Smith. Different situation now. Now, whether Shayne Elliott gets in there and cleans it out completely is a moot point, but that's a risk in the first half profits that he does do what new CEOs do. But having a look at the Asian operations in isolation, they're under pressure because they're in the region, they're in the China region, and so trade-facing clients are obviously getting hurt as trade and economic growth in the region slows. And so their bad debts, Asia related, are significantly higher than they were in the previous quarter, and they're going to be significantly higher in the first half. And we've upgraded our full year bad debt impairment quite substantially to just a bit over 1.5 billion. Now, having said that, the underlying business of ANZ in Australia and New Zealand again is very good, and it's the Asian problems aren't really going to upset that. Again, the result was better than expected, marginally, and we expect dividends to be slightly off in 2016, but then going higher in 17, and so both banks are in pretty good shape, and the other two are in probably better shape because they haven't gone offshore. Just notice that the Commonwealth Bank and Westpac haven't gone offshore. The two that went offshore have had some problems.
Peter, Woodside saw its profits fall following the slump in the oil price that we've seen. How should investors be approaching the energy sector at this point in time?
Nick, I think cautiously, unless you're have a risk profile that's a lot higher than others. But having said that, we believe that the oil price at around 30 is unsustainable and won't attract any investment just to keep production where it is, let alone increase production. And the world oil price will have to rise and rise meaningfully from here for that to happen. We think that's probably going to start happening later this year and into 2017. Woodside's earnings down 60% at the underlying level for the year, just over 1 billion, and the dividend followed. But having said that, cash flow was better than we expected. The balance sheet's in quite good shape. The gearing is around about the low 20s. They have, good opportunities, and in the energy space, it is going to be, The ones that are on the low end of the cost curve are going to do okay. We believe that, Woodside has halved their operating unit costs in the last 2.5 years. We'd probably rather be in Woodside, albeit it's probably a safer vehicle, but you aren't going to get, if you like, the turnaround and in terms of market price as you might get in the Santos. But Woodside's a safer play, and at this current prices, it's in our accumulate zone.
Finally, Peter, Telstra booked a tidy lift in its profit and dividend and generally met Morningstar's expectations, but was the result completely free of gremlins?
Yeah, that's an interesting question, Nick. Gremlins, I suppose, not really. I think that the result was reasonably clean. What impressed me was this top line growth of 7.8%. So the revenue line was good. Mobile, which is the engine room of the business, was just up a little, but network applications and services, NAS, really did hit its straps. And we knew that fixed line, or the old legacy assets, the fixed line and voice, they were coming off, but they didn't come off dramatically. Cash flow was very, very strong again, and what surprised me was, the 14% lift in operating costs. You say, well, here's an operation that's got revenue at 7.8 and costs running at 14%. I don't want to be near it. The fact is that in this space, this telecommunication space, which is dynamic, if you're a sitting duck, you're in trouble. You have to move, and you have to move to protect the assets, the operating assets you've got, and that's what Andy Penn is doing. He knows that he has a very, very major share of the mobile market. He wants to maintain that, protect it, ensure that the network has the capability and is the number one network from an efficiency point of view, and that's what he's doing, and he's investing in that. And that's sensible. They've experienced competition before, and they'll deal with it. What he's doing is he's investing in the future, not the past. And that's what we want him to do. Yes, they might say, okay, well, the risk profile of Telstra might lift a little, but if you don't take risks, you're not going to get rewards. He's got a very, very large defensive part of the business, which is going to protect him. But having said that, I said, he's protecting, looking for the future. So we believe that, the dividend is up a little bit and going to continue to edge higher. The financials are good. He's got plenty of scope there. Free cash flow guidance still strong, 4.6 to 5.1. All up. Nothing, not blowing lights out again, but nice defensive yield of 5.8, fully franked, grossing to over 8. We still think people can be comfortably hold Telstra at these levels, and we've got it slightly in the accumulate zone.
Peter, thanks very much for your time today.
Pleasure, Nick.
I'm Nick Grove for Morningstar. Thanks for watching.